Thank our panel again for taking time to be here. One of the primary concerns I hear out of our district from small, locally owned banks and credit unions is the cost of compliance. Dr. Kupiak, you mentioned in your testimony the tendency for banking regulators to apply best practice supervision on supervised institutions. If you'd speak to how does this impact those institutions, and as well the TAILOR Act will require regulators to examine potential unintended impact of examination manuals or other regulatory directives, and that works in conflict with tailoring the regulatory actions. Will this alleviate some of that impact?
Yes, thank you. The tendency for large bank, the examination and regulation of the largest banks is really to adopt a very data-intensive approach where you have large databases and comb through the data and use models and apply all kinds of fancy statistical techniques which may or may not work, but we have a tendency to like to do that in the largest institutions to create very complex regulations. And this permeates down through the examination team of examiners. They, if you want to move up in the world, you want to be a big bank examiner, not a small bank examiner. And what's the best way to do that? Well, you try to learn what the big bank examiners are doing, and you try to impose it on the banks you're examining, so that you get experience in the field, you get recognized. I think it's a natural problem with the system and then it starts imposing more and more data requirements, more and more data processing, the need for more and more vendor models, all kinds of things for small banks that probably really aren't necessary and don't have a benefit. So that's my experience working in a bank examination agency.
So essentially, Mr. Stanley had asserted that there were exemptions that were created for small banks. You're stating that's not really the reality. We're seeing the unintended consequences of regulations that are impacting small banks, and just having regulations that the TAILOR Act would require that are going to be sculpted for those institutions would make good common sense?
I think what Mr. Stanley says is technically correct. There are lots of places in the law that differentiate between the size of the institutions. However, there's never a clean break between a certain size and another size. It depends on the business practices and what kinds of loans they're, what kind of area it is. There's all kinds of considerations, and I think the TAILOR Act speaks more to a duty and requirement of the regulators to pay attention to these differences, whereas the very sharp limits in the current law are really not up to the task of differentiating really between risk profile and the best public interest of what's really required.
Thank you. You know, one of the frustrations that we hear, I'd had the opportunity to be able to serve on a small local bank and used to be able to make what were called character loans, knowing the people that you actually work with. And I'd like to be able to give you one example that's out of my district. I have a small business in Vail, Colorado. It's a ski and bike rental shop, had it for over 20 years. This gentleman applied to refinance his primary residency, but based on a 2-year average of his 2013-2014 tax returns, he didn't qualify. His 2015 profit, however, P&L statement showed that his net income was in excess of the 2014 tax return, but it could only be used to be able to support the 2-year average unless he paid thousands of dollars to be able to have an accountant review his 2015 financials. In the end, he had to be able to pay off a couple of auto loans that he had to his detriment in order to be able to qualify. This signals to me the loss of that relational banking ship that I think is so important in our community banks. Mr. Ireland, will tailoring regulations to community banks and credit unions, would this model enable these institutions to increase consumer and commercial access to credit?
It should. I think that's the intent, and if the regulators respond appropriately to it, they should lessen the burdens on smaller institutions, and character loans should come back. We saw this problem in the 90s in response to the thrift crisis. The character loans dried up. We're seeing it again. The regulators try to do things risk-based, but risk-based often means we're going to increase the scrutiny on the bigger guys. We're not going to reduce the scrutiny on the smaller guys, and the scrutiny trickles down. It just does. We tell banks to look sort of one layer up in the regulatory tiers, in doing their own planning just to be safe, because that's what the examiners tend to do. That's the standards they tend to hold them to.
Thank you. My time's expired.